Crypto Hotep here with another investing video. We are on week 69 of the Family Portfolio and Dividends Tracker. If you're unfamiliar with these videos or this series, if you will, feel free to go to my channel, go to week number 1, and that's where I break it down for you in regards to my methodology, the reason behind why I'm doing this, and just the general idea. So, very quickly, I shortlisted some companies and stocks for my family to choose from. They picked the companies that they most resonated with or the ones they were familiar with, and then we proceed to use M1 Finance as our broker of choice. You'll see this in a second. With M1 Finance, you can have a big portfolio that we call the family portfolio, and then you have sub-portfolios in it, which is everybody's stocks, every one of my family members' stocks. So every week we'll go through this portfolio. We'll talk about things like our emotions, how we're feeling about the market, any deposits, any balance changes, any dividends that were paid out, and just track that investment journey. These videos are for my own edification first and foremost, but if you find them helpful, feel free to like, subscribe, comment. Let me know what you think. It helps out the algorithm and it helps out my channel greatly. But by no means is this financial advice. Please do your due diligence when researching stocks. But with that being said, before we go to week 69, we go back to week 68, back to that recording of YouTube, and just kind of see where we were at. So in week 68 last week, we were at $26.71 and 17 cents in the balance. We had dividends earned of $14.28 and a market gain of $51.05. So this week, again, we're boosted a little bit here, $27.92 and 53 cents, so $2,792.53, a market gain of $72.47, and then dividends earned of $15.20 for a money-weighted rate of return year-to-date of 4.08%. So we've upped our balance, we've upped our rate of return, and we've upped our dividends. It's a good day. It's a good week. So one thing with M1 Finance, they have a new feature here that you can toggle between time-weighted return, and here's kind of the breakdown, and then the money-weighted return, and here's the breakdown for you. So, and then you can click the hyperlink to learn more. I personally I'm keeping it on the GOAT, which I think is the money-weighted rate of return. But if you use M1 Finance, do your own due diligence and see what works best for you. So let's see what happened with the activity. So between this week or last week and this week here, we had a little dividend activity with McCormick, 4 cents there, which I'll take all day, pennies from heaven. And then we did have an extra balance. We had an extra deposit. So if you are familiar with the channel, we don't deposit a ton of money in this account. We only deposit about $15 every 2 weeks. But if we are blessed with another payment, another bonus payout, or anything like that, then we'll put more money in here. And so this is what we did. We've deposited 100, and then we have 15 buys that equated to that 100. Minus, say, 6 cents or so. And with M1 Finance, you can buy fractional shares all day. There are no fees with that, and it's fantastic. So Starbucks we bought, Google, Pepsi, Public Storage, McDonald's, CrowdStrike, Tesla, Costco, Sony, Procter & Gamble, Amazon, Vici, Celsius, and Target. So we did go shopping. So let's see how the portfolios are stacking up. Bottom to top, we're going with my wife on the bottom. But as we all know, if you've been following, she has the best money weighted rate of return year to date out of anybody. And it rivals even heavy investors in the game right now. Her money weighted rate of return year to date is 22.49. That's not a typo. Dividends earned of $1.30, market gain of $42.40. That brings her balance to $339.23. Now, the good thing is it's not just Celsius that's pumping her portfolio, even though it is pumping it at a hefty allocation at she's getting 85.53% gain on Celsius. But Pepsi's in there at 3.85% gain, and then Google's finally picking up steam at over 11.5% gain. Tesla, we're down year to date on Tesla, but that is common, especially with Tesla having a little bit of dismal earnings that they reported. But I think all is well, or all will be well with Tesla in the long run. Let's go to our middle stock. Our middle stock money weighted rate of return of 2.58% year to date, $1.47 dividends earned, market gain of $4.63. Money weighted rate of return of our middle stock, $346.91. So Amazon carrying the weight here, as well as Google and Sony and Starbucks, but Target and Tesla are weighing it down, as we know. Now Target, I believe, is bottoming out. We are closing the gap in on Target, which is nice. I think we were down maybe 13% or so last week. So now we're down about 11.95%, which is nice. And then Tesla, we already spoke on that there. Okay, and let's go to our youngest. Our youngest also has a positive return of 2.16%, dividends earned of 87 cents, market gain of $4.91. That brings our youngest balance to $369.06. Let's see, with our youngest, it's a similar story like with Tesla, but Sony is carrying the bulk of the weight here, kind of evening out Tesla here. So they're up 17.02%, Costco up over 3.58%, and the Starbucks up over 6.5% here. Apple is down, but again, we're closing the gap on Apple. Apple, I believe it's held that $200 price for about 9 weeks, going on 10 weeks now. It's held 200, meaning price hasn't collapsed below 200, and that's good to see. You don't want to see price or stocks trading for Apple below that 200 mark, because it's a very key psychological level, and I believe we may be breaking out of that level for Apple. A lot of people kind of poo-pooed Apple. Hey, they don't know what they're doing. They're kind of just stuck in quicksand. They think it's the olden times here. They're not developed with AI. And I think people are going to be very surprised with how AI is driven with Apple, if I'm being honest. Let's go to our oldest stock. Our oldest has a negative money weighted rate of return of a negative 6.95%, dividends earned of $2.90, market gain of a negative $55.11. That brings her balance to $821.35. Now, I clicked off of that too quick, sorry. So again, culprits are Apple. Apple's down over 11% in our oldest portfolio, but McDonald's still up over 4% on McDonald's. Costco up less than a percentage, but up 0.22%. And then Tesla, as we just mentioned, again, a lot of the family holds some of the same stocks. They're overlapping, so you'll hear that name a lot. And if one's down, more than likely the other's down in the same or in a different portfolio, very similar to Tesla here. So let's go to my stocks. So my stocks, year to date, my money weighted rate of returns, not bad at 12.06%. I will take that all day long. Dividends earned of $8.66, market gain of $75.64. And my balance is $915.98. So the big reason behind this is we've upticked in industrials and energy. Industrials energy weighted rate of return is over 15%. Okay. Technology is also big. Technology is having another green week. It was also green last week. And if we click into this, you'll see Coinbase was at the top last week. Now Google is the king on the mountain right now. Nvidia still up, Amazon still up. Apple, as shown in other portfolios for my family, is down, and it's also down in my portfolio as well. They're the only tech stock, which is crazy, that is down. It's just amazing. It's crazy what Apple's doing right now, but I still have faith in Apple, as I mentioned. So industrials and energy, as I mentioned, up over 15.25. Restaurants and food up over 10%. Very impressive here. And then pharmaceuticals up over 9.5%, but those growth stocks, they are stonking, I'll tell you that much. So one thing I did do is I did adjust my allocation of growth stocks to 10%. So I took off the 5% for finance and put that 5% in growth. So finance, if you're unfamiliar, it holds Amex, Moody's, Visa, Aflac, and Berkshire Hathaway. Now, I took this off because I looked at the dividend rate, or the dividend yields, I should say, of that portfolio sector, and it was about 0.75 to 0.9%. Okay. And then I compared that to the growth stocks, which none of them give a dividend at all. It's mostly growth. And I thought that was a fair trade on the dividend yield because I would make up that much in the actual growth. As you can see, the money weighted rate of return is close to 8% here. I'm basically 3xing that with growth stocks. So even trade for me, and I get more exposure to the growth stocks, which I'm not bad. I'm still not going crazy because again, it's only 10%, but it's just an upped allocation percentage here. Okay. So yeah, honestly think, guys, that if we look back at the portfolio, if you're looking at the year-to-date numbers, 4.08%, that's not like generational wealth rates of return. But I'll tell you what, if you zoom out and go to the year time frame, now you're getting 17.63%. Dividends earned are double digits, $23 over $23, and then your market gain is $251.82. So it's very encouraging to see where you can come from. And again, we've been doing these videos for over a year now, and we started at very humble beginnings with a couple $100 in the account, and we've grown it to a tremendous amount. Not putting a lot of money in, right? So not putting a lot of money in, but just consistently putting money in, rain, sleet, or shine. No matter if there's tensions in the Middle East, no matter about the tariffs, no matter about the election, no matter about anything, we're still consistently putting money in and investing. Because I truly think that if you're trying to build generational wealth and you're trying to build wealth for your family and for yourself, you're not going to save your way to wealth. It doesn't work like that. Only because high yield savings accounts only generate, at the most maybe 4% now, APY on the interest for those high yield savings accounts, and the S&P 500 generally returns at about 10% per year. So, it would behoove you to put your money in investments and just stay diligent and just stay holding. I think what happens is a lot of people get dips where, like, for instance, if, we look at this 1-year chart of the portfolio, and there's been dips in this portfolio. If we look at April 2nd, this year, we went from over $2,000 back down to 1803, right? So we dropped almost $200 right there. And some people probably would have gotten scared, maybe would have sold off of everything and stuck it in cash, but that's not what you need to do. I think from an investing standpoint, if you have your money right, meaning that you can budget accurately or close to being accurate with your budget, it makes investing easier because now you're not overextending yourself with putting money into investments where you need to sell them really quick to maybe pay some bills or keep some cash stashed away. Like, you've already budgeted that money correctly, and the money that's going to the investments, it's good to go into the investments and stay there and accumulate and compound, which it needs to do. So I'll get off my soapbox here, but breaking it down for you guys, week 69 again, we had a balance of $2,792.53. We're going to go back to year to date here. With a year to date of 4.08%, dividends earned of $15.20, $72.47 is the market gain. Again, if these videos are helpful, guys, please like, subscribe, comment, let me know what you think. It helps me, it helps the algorithm out. It pops that video up into people's search bars, and you'd be supporting the channel. So, but as always, guys, thank you for watching, and happy investing.